Do you own mutual funds or think about getting involved with mutual funds? And if so, then you're going to want to stay tuned to this week's episode, Mutual Funds, the Good, the Bad, and the Ugly. You're listening to the Retirement Income Source, where it's all about the income. And welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host, Sarah Samuels. And today, we're to be approaching mutual funds, the good, the bad, and the ugly. Now, Sarah, do you own mutual funds, you and Justin?
Well, Dave, first, yes, we do invest in mutual funds, but I want to thank our audience, our listeners, for joining us today and for joining us this
manners
weekend.
First, I apologize.
Manners first, and we always appreciate you spending your time listening to us right here on the Retirement Income Source. And mutual funds, they're a hot topic, Dave. I invest in mutual funds. Justin, he's invested in mutual funds, and they do have some good qualities. I think that it's a great way to diversify, once you're trying to grow. Like, I'm in the accumulation phase of my life right now, so I'm trying to grow my money as much as possible. But what are some of the downsides, especially as you head towards retirement?
Well, at your stage of life, mutual funds are okay.
Yeah.
And
because you had me worried for a minute, Dave, with all the bad talk about mutual funds.
I said good, bad, and ugly. I was a little bit balanced.
I just heard the bad and the
right?
ugly.
No, but I think mutual funds fit for two groups of people. One, younger folks in the accumulation stage. And number two, if you don't have enough money to cost effectively diversify. How much is that? Maybe $250,000, maybe $500,000. But those two go hand in hand. Usually the younger folks tend to have a little less money and therefore can't cost effectively diversify. The good news is, mutual funds are more appropriate for them. But Sarah, to answer your question, the bad parts. Well, first of all, most mutual funds do not generate income, right? And as you know, on the Retirement Income Source, it is all about the income.
It is.
Because our audience consists of people who are retired or approaching retirement, and mutual funds generally don't have a very competitive interest or dividend payout. The second problem with mutual funds is that they're really opaque. So there's hidden fees in a lot of them, and it's really hard to dig through to find out how much the fees are. So you lack transparency. The third problem is they're not tailor-made for you and your goals. So it's kind of cookie cutter. And again, if you're going to retire in 30 years, maybe that's okay. But for a particular fund, you might have a 20-year-old, a 50-year-old, and an 80-year-old invested in those funds.
Yep. And
the fourth thing I would say is that you can get some tax surprises with mutual funds, especially if they're not in 401ks or IRAs, where you can have a loss year, but actually have to report a gain on your tax return. So again, some good things for the right people, but for our income generation, for those who typically listen to the Retirement Income Source, those retired or approaching retirement, probably truthfully more negatives than positives.
Yep. Well, let's get into our Ask Dave question. We have a question here from Beverly in Texas, and it's about mutual funds. So she's asking, what types of mutual funds are there? Because there's a lot of different funds out there, Dave.
All right, Beverly. Well, great question. And let's start with the basics. So thank you for getting me grounded here in the basics before I get too far down the path. There's basically three classes of mutual funds. There's stock funds that have stocks inside them, bond funds that have bonds inside them, and then cash accounts, which are normally known as money markets. So, of course, stock funds have many different types. There's stock funds that invest in larger companies, and those that invest in smaller companies. Those that invest in domestic companies, or those that invest in foreign companies. Those that are more growth-oriented, or those that are more value-oriented, as we always talk about on this show. So there's lots of subcategories in there. In the bond funds, the same is true. You can have government bond funds, municipal bond funds that have all state and municipal bonds inside, or corporate bond funds. Frankly, Beverly, you can divide corporate bond funds into different categories where you have high quality bonds inside. Those are loans to companies that have a good credit rating, let's say, like be as if, you have a good FICO score. And there's some that are more what's called junk bond funds or high yield funds, which are those funds that maybe have a lower credit rating and therefore they have to pay more interest to borrow money, right? And then to make it even more complicated, Beverly, you have these target funds or these retirement goal funds. And the theory of those is that if you want to retire in 2050, let's say 27 years out, they're going to have you in a more aggressive allocation. But if you invest in a 2025 fund, you're 2 years out of retirement, they're going to have you in a more conservative allocation. And they gradually adjust to get slightly more conservative as you approach retirement. So mutual funds, to begin with, are designed to be simpler, where you just put a few dollars in a mutual fund and you own parts of a diversified portfolio. But these target funds are designed to make it even simpler than that.
Well, Beverly, thank you so much for sending us your question in via the Ask Dave email. So if anyone out there, any of our listeners out there have a question that you'd like Dave to answer potentially on a future show, all you have to do is send us an email at askdave@retirementincomesource. That's SOURCE.com. And thank you for spending your time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and today's show is all about mutual funds and ETFs and mutual funds. We're talking about the good, the bad, and the ugly. So Dave mentioned when they can be good. He also talked about some of the negatives, which is that they don't really have an income portion. There can be some hidden fees and a lot of opaqueness within the fund. Plus, there's no customization. And Dave, we know that the word cookie cutter is kind of a bad word here on this show because we're always talking about different ways that you can really customize options for people. And I personally think that this idea of a plan, right? Like when you're in the accumulation phase, when you're in the growth phase, this abstract idea of what you want retirement to look like, that can work. But as you're getting into retirement, 5 to 10 years away, you really got to turn more towards that strategy that's customized for you.
Yeah, and if you're mostly stock funds because you're younger, stock funds are, again, they have the problem of being opaque, and they have the problem of you not having the customization, the extra fees and everything. But if you're closer to retirement and you're trying to get involved with bonds and use bond funds, now again, that's a pretty significant issue, because when you buy an individual bond, you do it for two reasons. You have a fixed interest payment for the life of the bond. And that's why retirees and people approaching retirement like bonds, right? Because they have a fixed interest payment. And they know if they hold that bond to maturity, they'll get their principal back in full, providing the issuer hasn't gone bankrupt. So they know what they're going to get. Well, when you buy bond funds, guess what? Those two guarantees we just talked about, well, now you can forget about them because they're off the table. Because when you own a bond fund, you don't own bonds. You own the stock of a company that owns bonds. So if it sounds riskier, it's because it truly is.
Yep, they're not the same thing. And actually, bond fund might actually be another bad word on this show. We've had two bad words so far on this show.
That's right.
But I think it's important, Dave, to explain the difference. Like you mentioned, a lot of people hear the bond part and they miss the bond fund part, and they're not understanding that it's mutual funds in the bond market. They think, hey, Dave said this is good. I heard the word bond. I'm safe.
And I think that's one of the reasons, too, why companies, where you're limited to bond funds is most 401ks, most 403bs, most 457 deferred comp plans, right? If you have an IRA, well, then you can invest in whatever you want. Now, you might still be in mutual funds, but that's your choice. And I think that's why most companies now have morphed into something where by the time you get to age 59 and a half, even if you're still working, they let you do something called an in-service rollover, Sarah. They let you roll the money over to an IRA because they realize that they've got limited options in there that are great for people like you in those accumulation years. But certainly once you get to age 59 and a half, you're close enough to retirement where you need to be more flexible. You need more options.
Yep, absolutely.
And coming up, we're going to talk about some of those options, but we're going to talk more about bond funds, the good, the bad, and the ugly. I'm David Scranton, here is Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and we're talking about mutual funds, the good, the bad, and the ugly. So far we've talked about some of the benefits of mutual funds and how they can be good for smaller accounts to be able to diversify if you have less than $250,000 or so. But we've also talked about some of the negative sides, that they can be very opaque. There could be some hidden fees there. They also don't offer income options or customization. But Dave, I have to bring up, I think one advantage that the mutual funds would have is that they're larger. So they have more economy of scale, right? When it comes to purchasing these different stock and bond options.
People might think that, And that's really good logic. The problem, Sarah, is the opposite is actually true. You see, when if you have, let's say, a $100,000 position in a publicly traded stock, you can sell that stock all at once, and if it's a decent-sized company, you won't even affect the price. If the price is $50.05, that's what you're going to get for all the shares. But if all of a sudden you've got 100 million in that stock versus 100,000, you can't sell it all, because if you start to sell it all, you'll drive down the price. Conversely, if you're trying to buy that big of a position, now you'll drive up the price as you start to buy it, right? Yeah. So you either have to buy it and pay more, sell it and get less, or make the transactions more gradually, and they call it working the trade. But the problem with that is if you're buying it because you think it's cheap now, when other investors see that XYZ mutual funds buying it, guess what? They may buy it and drive up the price where it's no longer a good deal. So you're forced to buy in or sell in little bits and pieces, which is not ideal if you're a portfolio manager.
Yep. So it kind of seems like it's a double-edged sword. There's some benefits, but really it's the opposite is true.
It's like a hidden fee. That size is like a hidden fee because, again, you're going to end up selling for less than a small investor and buying for more many times, paying more on the way up because you have so much quantity.
Yep. Well, speaking of hidden fees, Dave, and you mentioned this a few moments ago, but you mentioned that there could be a hidden tax issue when you purchase bond funds. Can you explain more?
Yeah. Let's say that I owned a bond fund for a long time. So I made a lot of money. It went up in value. Any kind of mutual fund, bond fund, stock fund, it went up in value. I've made a lot of money. You get in January 1st of this year, and the fund goes down. So by December 31st of this year, I'm still in the black because I've been in it for a decade. I've made money, even though this year was bad. You've lost money. But there's some holdings in that portfolio that are up in value. And if the fund manager sells those holdings at a profit, they distribute that profit to us and we have to pay taxes on. Now, I may not mind because I've made so much money, but you've lost money. So you inherit my tax bill, and you get the same 1099 I do, because even though you bought it at a high point and you haven't made any money left. So there's what I call a phantom income tax built in. And I don't mean that based upon the IRS definition of phantom income tax, but that's one of the negatives of mutual funds. Now, of course, Sarah, if you buy them in IRAs or 401ks, you don't have to worry about that.
Yeah. Well, let's talk about 401ks, Dave, because we got a question here from Jake in Alabama. He says, I'm in a 401k and I'm almost 59 and a half. I'm not there yet, but I'm almost there. How can I determine my right allocation?
Okay. Well, Jake, first of all, you have to say, okay, I'm stuck with these mutual funds in the 401ks. I can't do the in-service rollover, so I have to make the best out of it. And again, it goes back to your goals. It goes back to how much income you're going to need and want in retirement. And do you have enough money to generate that income? Now, you may not be able to generate it today in the mutual funds in the 401k, but once 59.5 comes and you can do an in-service rollover to an IRA and the investment world opens up to you, then at that point, do you have enough in there saved in a lump sum to generate the income you want? If the answer is yes, it gives you more flexibility. For example, I've seen some people just say, well, I'm 57 and a half. I'm going to go into a fixed interest fund. I might only make 3%, but I'm going to sit there and make 3% for the next 2 years. Then when I'm 59 and a half, I'm going to roll out. Why? Because I want to retire in my early 60s, and I'm worried if we get a bear market and I could be stuck in a trough, and I don't want to do that. I don't want to postpone retirement. So if you have enough to generate the income you want or need in retirement outside of those mutual funds, then maybe you could take an ultra-conservative approach like that and wait for that in-service rollover age. But if you don't and you still need to get more accumulation, then you've got to find the right balance of investments that fit your risk tolerance level. And it's going to be a balance between stocks and bonds. Obviously, stocks are more aggressive. Bonds are generally more conservative, even bond funds. Not as conservative as a diversified portfolio of individual bonds. But you're going to want to figure out what that proper mix is. And you're going to want to look at the funds. And a great tool out there is Morningstar. And you could sign up for Morningstar free, or you could pay a little bit more money and get a little bit of a more robust version. But Morningstar can help you because it can help you identify how much the hidden fees are inside the funds, how much risk that fund is taking relative to its peers, what it's paying out for a yield, an interest or dividend payment, and give you lots and lots of valuable information. So again, you're going to want to do your research and make sure the balance of funds is within your personal risk tolerance level.
Jake, thank you so much for sending in your Ask Dave email. And if any of our other listeners out there or YouTube viewers have a question or a comment or concern, anything you want to share with us here on the show, all you have to do to reach out is send us an email at askdave@Retirement Income Source. That's SOURCE.com. And thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels, and I'm here with David Scranton. And today's show is all about mutual funds, the good, the bad, the ugly, when they might be something you want to invest in, when to really shy away from them. And we just were talking about, this 59.5, the magical number when you can do a rollover with your 401k. Dave, are there any other times when you are able to roll over a 401k or shift that 401k into another account?
There are times, when you leave your employment, you may have a new 401k you're starting with your new employer, but the old money that's in the old 401k can be rolled over to an IRA with no problem. So that,
and should you do that if you do leave your employer and move to a new one? Should you always move your 401k?
I wouldn't say always.
Yeah.
If you don't have enough money to cost effectively diversify, or if you're young and early on in your accumulation years, then maybe it doesn't hurt you if you leave it there. But don't forget about it. Still pay attention to it. Still, do what I just mentioned a few minutes ago. Look at Morningstar, look at the funds, make smart decisions. Don't just sit there and let it lie fallow. That doesn't make any sense. But if you've accumulated enough to cost effectively diversify, or you're within 10 years or so of retirement, then you absolutely should roll it over to an IRA, because then the universe of options opens up to you.
Yep, and that's extremely important. I know that there's a lot of times, like we mentioned, the tax issue, the hidden tax fee, which you mentioned. If you're buying it high, you didn't make any money, and yet you're still kind of subsidizing maybe the person that did actually make some money, and that could be the hidden issue. And really with mutual funds too, it's this opaqueness, not really understanding all the fees or all the things that go into it. That also seems to be another big issue. So besides turning 59.5, Dave, leaving your company, is that pretty much it when it comes to moving your 401k? Are there any other times when you might be able to do that?
Those are pretty much the options.
Yeah.
In case of divorce, if one spouse is getting via court judgment part of the 401k of the others, then that spouse who's receiving that part of the 401k can do what's called a quadro, QDRO, and can roll that over to an IRA. But the spouse who's sending the money over, if he or she is still working for that same company, then guess what? His or her money is still stuck in that 401k plan. So that's another scenario where, yes, you can roll it over to an IRA.
Yeah. Well, we've talked a lot about 401ks, but what if you have money outside of your 401k, or maybe you are right now, you're 59.5, or you're maybe a little bit over that, and you are ready to do an in-service rollover. What are all of the options available to you? There's a lot of options out there. So we're going to talk about that coming up. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it is all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and today we've been talking about mutual funds, the good, the bad, and the ugly, and when it makes sense to invest in them, and of course, when it makes sense not to invest in them. So what if you have money outside of your 401k, or maybe you're 59.5 and you are finally at that magical age where you could do that in-service rollover to an IRA? What are the other options that are available to you, Dave?
Well, Sarah, as you know, we talk about this all the time on the show. If you're in that age bracket where you're putting the income first, where all of a sudden you're starting to pay attention where your total return's coming from, and it's an income first, growth second philosophy, then you've got choices. If you're willing to take a little bit more risk or deal with slightly less income, you can deal with high dividend common stocks. You can still stay in the stock market, have some upside potential, but have an income first approach. If you need or want more income, or just are more conservative, then you get in the universe of bonds and bond-like instruments. So you can get into whether it's municipal bonds, corporate bonds, preferreds. As you know, preferreds are technically a class of stock, but they're more bond-like than they are stock-like. And then if you want to throw in a little bit of what I call bond-like stocks, such as BDCs, business development companies, or REITs, real estate investment trusts, you can do that too, and try to get a little more yield, a little more return.
Yep. And there's a lot of options out there. And I think for most people, it starts with figuring out your goals, of course, and determining what you're trying to do with this income, whether you're lump sum or whether you just want income in retirement to replace that paycheck. But I think it's a lot about it's looking at your risk tolerance and understanding what that risk tolerance is. And like you say many times, Dave, it's really internalizing it, looking at a number, thinking about what your life would look like if that number went down, and figuring out what's the lowest point you can go. What can you tolerate?
Yeah, if I've got $1 million, when am I going to start losing sleep? At 900,000, 800,000, 700? How's it really going to affect me? And more importantly, how's it going to affect me in retirement? See, it may have already happened where you've had huge losses during your working years, but the whole mentality, the whole emotionality behind it is different once you're in retirement. So yes, you got to focus on your risk tolerance level, but also your income. How much income do you want in retirement, and can you get there? Because like I said before, that determines whether you go more stock-based, those two things, or whether you go more based on bonds and bond-like instruments. So lots of tools, lots of choices that people have once they get out of this finite mutual fund world.
Yeah.
And it's all customs. It's all can be all customized, and that's the beauty of it. Again, based upon your goals. So, as you said, Sarah, the first step is you have to know what your goals are.
Yeah, a lot of people don't know. It's surprising. A lot of people, it's an abstract concept. They haven't thought concretely about which goals they want to accomplish in retirement.
And it has to do with, okay, there's a little bit of money I want to buy an RV with. That's a lump sum goal, but the rest of it's there for income. Okay, now on the portion that's there for income, great. How much income do I want? And can I get there right now, or do I need to have more accumulation before I get there? But don't forget the first step, which is, like I said, what's the money there for? Is some of it going to go for a lump sum? Great. Well, then you're back to total return. No problem, like you've always been. Yeah. But if it's income-based money, then that's going to replace your paycheck, then you have to make that transition in your mindset. So.
Yep. Let's get into our Ask Dave question. We have a question here from Carla. She sent us an email from Rhode Island, and Carla says, my husband and I have some money that we can roll over to an IRA and some money that we can't roll over. So how do we determine how much that we should put into stocks and bonds?
So you have some money that's going to be trapped in a 401k, some money that's not. So you're trying to figure out where to go. It's difficult to answer, Carla, because you probably don't have high dividend stock strategies in your 401ks or 403bs. But then again, you also don't have individual bonds and bond-like instruments. You have bond funds. So, if I were to answer that question before, it might be different. But right now, the Fed is pretty much done hiking interest rates. We might have one or two more hikes, but interest rates are at the higher part of the range, not the lower part. So it's a good chance to lock into some good yields with bonds and bond-like instruments. So what I might lean toward is saying, hey, take that IRA money that's more liquid and use that for more bonds and bond-like instruments, and then just realize that the money that's still trapped in the 401k is going to have to be in, that probably is going to have to be more stock-based, and unfortunately stocks that don't pay a good yield. So you might be stuck with stocks that pay just a lower dividend rate, but again, in general, the stock funds are not as big of an evil as bond funds can be if you have enough to cost effectively diversify. Because remember, when you go from the bond funds to those individual bonds and bond-like instruments in your IRA, now you know exactly how much income you're going to get for the life of those tools, provided, of course, that there's been no defaults or bankruptcies. So that's probably the simple answer, but it all depends upon your situation, your goals, and how much money is now still going to be trapped in the 401k. And versus how much money is going to be able to be rolled over.
Yep. Well, Carla, thank you for sending us your Ask Dave question via email. And if any of our other listeners or our YouTube viewers out there have a question that you'd like Dave to answer potentially on an upcoming show, all you need to do is send us an email at askdave@retirementincomesource.com. Thank you for spending your time here with us listening to the Retirement Income Source, where it's all about the income. And today, it's really been more all about the mutual funds, right? It's It's the good, the bad, the ugly. We're really trying to help educate our listeners on what these funds are and what they look like, especially if you're looking at stock funds, if you're looking at bond funds, and if you're looking at the money market accounts. So, Dave, can you give us what's your best advice right now? You mentioned a little bit about what we're looking at with the Fed, and they're probably not going to raise interest rates anymore. But for someone that's planning to retire, within the year, what would be your best advice right now?
Within the year, well, the best chance is to, if you have enough to retire and, most of that money is going to be used to generate income, then you want to lock in that income now. Do the best you can to lock it in because, God forbid, we do see a recession and the Fed does break the system trying to kill inflation. And then the market takes a drop and now you have less money. But if you go to income-based investments, even if it's a higher dividend stock strategy, then you don't have to worry about it because as that, as the stocks drop in value, companies are really reticent to reduce their dividends. So the dividends remain sticky.
Yeah. And why is that? They don't want to rock the boat, so to speak, unless it's a dire situation.
Well, remember, the number one job of the CEO of a publicly traded company is to keep the shareholders happy, maximize the value of the stock, which in part is maximizing company profits. But shareholders really don't like it if companies cut dividends. So if you cut a dividend, shareholders are going to start to flee that company, especially retired shareholders. Yeah. It's going to have downward pressure on the stock price. So it's really a political hot potato within the company, if you will, if they start talking about cutting dividends. So it's very much a last resort. And the same is even further true when it comes to preferred stocks. When you start talking about preferred stocks, they're much more bond-like than they're stock-like. I mean, technically they're a stock, but, they have a fixed interest rate they call a dividend for the life of the preferred. It has a par value just like a bond, and it tends to fluctuate more with the bond market than the stock market. So especially in the case of prefers, those dividends are actually contractual.
Yep. And that's why those two aspects of the stock-like or bond-like stocks, I'm sorry, let me get it straight, that make it so similar to the bond. That's why people in retirement really appreciate these because you have that contract. You're almost guaranteed that you're going to get that money back when the life of the bond or the life of the preferred is up. So I think that's why a lot of people are, when they find out about them, they're very interested in these types of investments.
And that's why I feel bad when somebody is relatively close to retirement and they don't have the ability to do in-service rollovers. Yeah. If they don't have a pension, a traditional pension plan where they'll get hit for this, I'd rather have somebody, this may sound radical, just say, I quit. You go to HR and say, I quit. Can you hire me back in 35 days? Because now you quit, you get to roll your 401k over, you get to protect that money better, and then you get to go back to work at the company. Now, that's a little dicey and hard to do sometimes, but it's something to at least consider if you have enough points to win the game of life, financially speaking. You have enough money, and you want to protect it. You want to protect what you can lock in today for a retirement income stream, but you don't want to retire because you love what you do. Yeah. Maybe having a frank conversation with HR isn't the worst thing in the world.
Hey, maybe you can get your employer on board with it. It sounds a little sneaky, but you never know. So, we outside of your 401k, we know that when you are or 401ks have mutual funds inside of there. There are some reasons you might want to be concerned if your financial advisor has you invested in mutual funds. So we're going to talk about that. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
And welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton. Of course, I'm here with Sarah Samuels. And today we're discussing mutual funds, the good, the bad, and the ugly. And Sarah, right before the end of the last segment, you mentioned that maybe one of the things you've got to be really careful about is when a financial advisor charges you a fee for managing money, but yet has you in mutual funds. And I have to admit, that is one of my pet peeves, Sarah.
Yep. And it's really because you're getting charged twice. There's multiple fees kind of hidden in there. So Dave, explain why it's such an issue.
Yeah, well, think about it. If you're paying me a fee, let's say I'm a car mechanic, right? But I can't fix your car. So you come to me and say, I'm going to pay you a fee to tell me who the best car mechanic is to fix my type of car, so that then when I go to the other mechanic, I'm going to pay that person a fee also.
Yep.
Would you ever do that?
No, it's kind of like a finder's fee, but I'm paying you because you're a mechanic allegedly, but you can't fix my car, and you're going to now have this other guy fix my car.
That's right. And you might be paying your advisor a 1% management fee, but the average fee inside the mutual fund is likely to be another 0.75% to 1.5% per year. So you're getting double dipped. And see, here's the problem. All the research that your advisor would be doing, he or she doesn't have to do, because the fund manager in each fund is doing it. So it's the fund manager and all the analysts that are talking to these companies, talking to the CEOs, talking to the CFOs, deciding which stocks they want to buy, which ones they want to sell, which bonds they want to buy, which ones they want to sell. They're doing all the heavy lifting. All that financial advisor is really doing is picking maybe a half dozen mutual funds to put you in. And as I mentioned before, it's as easy sometimes as going to a company like Morningstar, subscribing to the service and reading about each fund and learning about it and creating an allocation. So it's a great business model for that advisor, because that advisor has his or her feet up on the desk, only has to do 10% of the work, but can still get a management fee. Whereas the second fee that you're paying inside the mutual fund, the hidden opaque one, that's somewhere on page 97 of the prospectus, is the one that's really giving you money in exchange for that. Now, Sarah, I have to admit, I understand there's more to it than that. That sometimes advisors don't have the bandwidth. Maybe it's an advisor with a couple administrative staff. They don't really have the bandwidth to pick individual stocks and individual bonds, whether it comes to maybe the knowledge level or whether it comes to the human resources to do it or the financial resources. I get that. But there is a better alternative if an advisor wants to have a slightly lazy business model and not do all the research of that stuff, maybe because in fairness he or she can't. And that is to use ETFs.
Okay. Explain, Dave. What are ETFs and how are they different?
Exchange traded funds. So ETFs are different because, first of all, there's a lot of ETFs that aren't managed, so the fees are negligible. Now, some are managed, so they have higher fees, so you've got to be careful. But ETFs are generally considered to be a better investment in if you're going to buy a fund, because they're much like mutual funds, but they're traded like a stock. So they have a stock ticker symbol, whereas a mutual fund, you can only buy or sell it at the end of the day. You can't buy or sell it midday. With an exchange-traded fund, an ETF, you could buy or sell it during the day. Also, if you have a margin account, you can margin against it. So it's a fund, but it's traded like a stock. So it's got, in most cases, lower fees, and it's got many more advantages for an advisor who's charging a fee as a fiduciary. And as a fiduciary, he's supposed to be able to actively manage this stuff, which is much harder to do in a mutual fund than it is in an exchange-traded fund.
Yep. And I want to talk more about ETFs in a few minutes, Dave, and actually talk about the ETFs that we can offer as part of Sound Income Strategies, the registered investment advisory firm for Retirement Income Source. But right now, I want to get to Ask Dave. We have a really interesting question that came in via email. Okay. This is from Daniel in Mississippi. So Daniel says, I'm a small business owner, and I want to put in a 401k option for my employees. So am I only limited to mutual funds?
Daniel, great question. And in a word, the answer is no, you're not. Now, the reason most plan providers limit it to mutual funds is because they figure that, some employees might be sophisticated, but there are a lot of employees that might be unsophisticated investors. And as a result, they're worried that if they allow individual stocks to be held in that 401k, and that person makes some bad decisions and loses all their money because they're not diversified or just made some bad picks, that employer could be held liable. So yes, you can do it, but there are liability concerns there also. One compromise per se is to allow an outside manager or managers to manage individual stock portfolios and bond portfolios if that per employee's account gets over a certain dollar amount. Another one is to actually let them do it with a portion of their money if they're over a certain dollar amount. So again, there are options where individual securities can be managed inside those 401ks. It's a little trickier. but it can be better for your employees who are nearing retirement. Because like I said before, the last thing you want is somebody listening to the show, taking my advice and resigning from your firm just so they can roll their 401k over, right? If they want to stay there, they're a good employee, you want to keep them. So providing those options are important.
Yep. Well, Daniel, thank you so much for sending in your question. And if any of our listeners out there, our YouTube viewers, have a question that you want to ask Dave and maybe have it featured on a future show, all you need to do is send us an email to askdave@retirementincomesource.com. Thank you for spending your time here with us listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton. Today, we've covered mutual funds, right? We've talked about the good. We've talked about the bad. We've talked about the ugly. Just a few minutes ago, we were talking about why you might need to be concerned if your financial advisor has you invested in mutual funds, and it's because they're doing that double dipping. Sometimes they might be double dipping, right, where they're making extra fees off of you. So, Dave, I want to shift gears really and talk more about ETFs, because I think the story that we have with Sound Income Strategies, the ETFs that you work to create, Divvy and Fixed, are extremely interesting, and especially the way that you got there to creating them. And I know we've talked about this before, but tell us a little bit about the backstory.
Well, backstory is really only to allow smaller investors to cost effectively diversify and have something that's actively managed. Because what we've done in our separately managed accounts is somewhat unique, and when we looked around the mutual fund world, the ETF world, to see if they were duplicated anywhere, they really weren't. On the stock side, we've consistently had dividend yields over 4%, and when I look at any exchange traded funds with yields over that, they usually cheat. They put real estate investment trusts or things in there, that MLPs that provide a very high yield, but really shouldn't be in there. And then when I looked at the bond world and how we manage bonds and bond-like instruments, there were really no ETFs that did that either. So, I'm not a big fan of ETFs, but I did it because I felt as though smaller investors need the ability to cost-effectively diversify and still have quality management. But it's and part of it's because the mutual funds are. You mentioned a moment ago, Sarah, that the mutual funds, some investment advisors who put you in mutual funds are double dipping. I would tell you they're double dipping no matter what, because you're referring to those that charge a management fee that act as a fiduciary, right? But even though that work on a commission basis, that if they're not fiduciaries, they're still getting a commission. And either they're taking 5% up front, or they're taking some amount annually forever, or they're taking a higher amount annually for 5 years, in which case you get penalties if you get out within 5 years. So even if a commission-based advisor who's not a fiduciary is doing it, you're still paying higher fees. But if you're with a fiduciary who's charging a fee, then I really have to tell you, I'm not sure how somebody could say they're a fiduciary and pretend they're acting in the capacity of a fiduciary, but yet be using mutual funds as a primary retirement tool inside those accounts.
Yep. And that's why it's so important for our listeners out there, our YouTube viewers as well, to really educate yourself so you can understand all of these different investments and understand why your financial advisor might have you in these things, and really understand ways that you can avoid paying those extra fees or even getting hit with that, the ticking tax bomb that could happen for you. And it's all of this extremely important, of course, heading into retirement, or if you're already retired.
Yeah, no, it's very true. And again, today we talked about mutual funds, the good, the bad, and the ugly. And, I know we come across a little bit more negative than positive, but I want you to understand it's because we're talking to you, our beloved member of the income generation who's retired or close to retirement. For your children, your grandchildren who are a lot younger, who have a lot more to go in the accumulation years, hey, it's not the worst thing in the world. After all, 529 college tuition plans are generally limited to mutual funds. But again, that's a lump sum goal, not an income goal, so it changes the story.
Yep, different story. Well, thank you again for listening to Retirement Income Source. And if you want to maybe send this episode to your friends or listen to it again, all you have to do is go to retirementincomesourceradioshow.com for all of our past episodes.
And we hope you do that, but more importantly, we hope that you join us right here next week, same time, same station. I'm David Scranton, here with Sarah Samuels, and this is the Retirement Income Source, where it's always all about the income.